Today, we're diving into a really interesting company called Zen Technologies. They're a huge deal in India's defense sector, but their story, well, it's a bit of a puzzle, and we're going to try and solve it together.
So, what does Zen Technologies actually do? Well, imagine the most advanced video game simulators you can think of, but for real-world combat. We're talking flight simulators, but for tanks, for missile systems, you name it. And on top of that, they're big into anti-drone systems, which, as you can imagine, is a massive deal right now. This isn't just cool tech. It's absolutely essential for modern defense.
Okay, but here's where it gets really strange. This is the defender's dilemma we're talking about. If you look at their stock over the last 5 years, it's just exploded, up over 900%. I mean, that's incredible. But then you look at just the last year, and it's down around 34%. So what's going on here? How can those two things be true at the same time? Let's get into it.
All right, to really get to the bottom of this, let's start with the good stuff. We're going to look at the bull case, all the reasons people are so excited about Zen.
First off, just look at this number. We're talking about compound annual profit growth of almost 37% for 5 years straight. That is just staggering. It's not just good, it's the kind of explosive growth that makes everyone in the market sit up and pay attention.
And this isn't some flash-in-the-pan success. The company's fundamentals are seriously strong. I mean, look at this. Their return on equity is a fantastic 25.5%. They're running with basically zero debt, which is always great to see. Plus, they've got the full backing of the government's Make in India push. And to top it all off, with over 170 patents, they've basically built a fortress around their technology. They're a leader in their niche for a reason.
Yeah, and this isn't just ancient history either. The proof is in the pudding, right? The orders are still flooding in.
Just look at this one, a massive 289 crore rupee contract from the Ministry of Defense for their anti-drone systems. A number that big isn't just good for the bank account, it's a massive vote of confidence from their most important customer. It shows their tech is exactly what's needed right now.
And it's not a one-trick pony either. It's not just the new anti-drone stuff. Their bread and butter, their core combat training simulators, are still in super high demand. Here's another order for 120 crore rupees. So the demand seems to be there across the board.
Okay, so that all sounds amazing, right? But that's only one side of the coin. Now we have to look at the other side, the bear case. What are the warning signs here?
And boom, here's the first big red flag. After all that talk about explosive growth, their most recent quarter was not great. Revenue dropped 28% compared to the year before. Net profit took a 5% hit. That's a pretty jarring U-turn from the story we were just hearing, isn't it?
Now hold on. To be fair, this happens in the defense industry. You get these massive, irregular orders, so the revenue can be what they call lumpy. You know, it's not a smooth, predictable stream. But even if it's expected, that kind of unpredictability still makes investors pretty nervous.
So you have this one bad quarter right after this incredible multi-year stock run. It naturally leads everyone to ask the million-dollar question, is the stock just too expensive?
And to figure that out, we've got to talk about the P/E ratio, price to earnings. It's a key valuation metric. Basically, it tells you how much investors are willing to pay for every rupee of profit the company makes. A high P/E means investors are betting on huge growth in the future. They're paying a premium today for what they hope the company will earn tomorrow.
And Zen's PE? It's sitting around 50. Now, for the industrial and defense sector, that's pretty high. It tells you that the market has already baked in a ton of future growth into today's stock price. The expectations are sky high.
So you've got two big issues piling up here. First, that high price tag means the company has to deliver perfectly just to meet expectations. Any slip-up could be a problem. And second, their CFO just resigned. A big change in senior management like that, right now, it just adds another layer of uncertainty to the whole picture.
So where does that leave us? You've got this incredible promise on one hand and some serious peril on the other. Let's try and balance the scales and see how this all stacks up.
And really, this table sums up the whole dilemma perfectly. On the left, you've got the bull case. Huge new contracts, a leader in a critical industry, fantastic long-term growth, and government support. It looks unstoppable. But on the right, you have the bear case. That recent drop in revenue, a really high P/E ratio, a key executive leaving, and that lumpy, unpredictable business model. It's a classic two-sided coin.
So with this clear conflict, where do the pros land? What are the market analysts actually predicting for the stock price?
Well, it looks like the analysts are leaning bullish, at least for now. The average target suggests about a 10% upside from here. Some on Wall Street see it going up by 22%, and the most optimistic brokerage target is forecasting a potential 31% jump. So, they seem to think the good outweighs the bad.
But, and this is a really big but, that optimism comes with a major catch. As this report points out, that rosy valuation can only be justified if everything goes right. They need to keep landing those big orders, they need to smooth out that revenue stream, and they need to execute perfectly. The potential is definitely there, but the pressure to deliver is immense.
And that really leaves us with the central question, the one you have to ask yourself if you're watching Zen Technologies. Can the company's future growth live up to its current, very high price tag? That's the core of the defender's dilemma, and it's the key takeaway from this entire story.